I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by partner and chief market strategist Chris Verrone. Chris, how are you doing this morning?
I'm doing great, Ross. Thanks for having me.
Yeah, absolutely. Great to talk to you. An eventful start to the year, so a lot to get to. I think it would probably serve to start with the equity markets
Yeah.
and focus both on what you're seeing from the weakness in tech and then how it kind of buffers against the more rotational tape, and then broadly what that just tells you about the economy.
Yeah, that is exactly, I think, where we should start because it's been a very rotational start to 2026. But frankly, Ross, as I think you know, it really predates that. Go back to like September, October, we began to see all this evidence that, what was once a market led by the very speculative corners was starting to transition into groups that really reflected the real economy in this very pro-cyclical tone. I think that has certainly continued, if not accelerated, in these first 5 or 6 weeks of 2026. And you see it through so many different avenues. Probably the most overt is the outperformance from the equal weight over the cap weight. I do think that is something likely to persist here, but you also, really see it through the lens of leadership. You see it with transportation stocks and chemical stocks and retail. You've seen the trucks and the freight names all turn up. The regional banks are acting great. Frankly, even some of the home builders are starting to inflect higher here. So there is certainly this kind of rotational grab to the market, this pro-cyclical, old economy, real economy, whatever you want to call that, happening at the expense of what was the very speculative tech driven part of the tape. I think the harder question, Ross, is as we think about this equal weight over cap weight, what does it actually mean for the index? I think certainly first half 26 or even 26 in totality could be a year where the index does not make a lot of progress, but under the surface the average stock or the equal weight is actually doing quite well. That seems to be the tone here, and that's what we're playing in position for.
Yeah, it's certainly the concentration risk we've been asked
Mm.
about and talking about for years. This is kind of what that can look like. Is even a strong tape under the surface might not be reflected by headline gains. Something else that continued from last year, straight through the new year into January was global outperformance of U.S. stocks. Alongside a weaker dollar last year, as has been reported on. What are you
Yep.
seeing from international versus U.S. and is that a story or a trend that you think can continue for the remainder of the year?
Well, I think it's important, Russ, to emphasize, and you kind of hinted this, that this didn't begin 4 weeks ago or 8 weeks ago or 12 weeks ago. I think U.S. market cap as a share of global market cap actually peaked in late 24. So, we're going on 14, 15 months of what has been this leadership rotation away from U.S. to other corners of the world. In the very near term, it may be extended or a little overdone, just given some of the narrative chase that's out there. But I do think the market's sending a very, very powerful longer term message that there is opportunities to be found outside of the U.S. And, where it's really most pronounced, emerging markets are making about 2 year relative highs versus S&P. So you're certainly seeing it through the lens of EM here as well. Now, what I want to be a little bit careful about is I don't think this is like some big sell America trade, though. The bond market does not reflect that. I mean, the U.S. bond market has been among the calmest relative to other parts of the world, certainly versus Japan or parts of Europe, whether it's Germany or France. So I don't think this is really some big sinister bond message. I think it's more about what has happened at the top of the market here. We have started to see the big stocks weaken. That by default opens up other opportunities in the equity world in other geographies.
Yeah, that's a great point. It's not an either or thing. There can be a
Yeah.
global growth upswing that America participates in, but so do other countries. So, a good note. I'd be remiss if we didn't end on precious metals. We've
Mm.
obviously seen, some crazy conditions in trading in those areas of the market. What are you seeing in terms of blow off top sentiment, and what do
Yeah.
those kind of conditions mean for metals over the next, 3, 6 months?
Well, I certainly think with silver, it's in the blow off category. I'm of the view that the highs are likely in there on silver. There was a point about a week and a half ago where silver was like 150% above its 200-day moving average. There was one day, I think it was last Thursday or last Friday, where the SLV, which is the silver ETF, did about 50 billion notional. A typical day would be like 1.5 or 2 billion notional. So we're talking about, call it 2.5 or 3 times, sorry, about 20 times average daily volume there. So certainly extreme in that regard. The title of our client note on Monday after the big decline in silver was, quote, "It could have been anything," meaning when things go parabolic, it doesn't take a lot for the wind to shift very quickly and very abruptly. We've certainly seen that. I would be skeptical of any bounce in silver here. I do think the highs are probably in. Gold's a bit more nuanced because I do think there is still some very real narrative about why gold has gone up. That certainly still seems to be in play. I'm just not sure how to measure risk reward on gold right now. And I think given what's happened in silver, my suspicion would be gold kind of does what it does or does what it did last spring, where it took 4 or 5 months off. It just consolidated. I think that's more likely. Where I still find there's opportunity is in the industrial base metal space. You never had the blow off conditions in things like copper. Copper still looks pretty good. The copper stocks still look pretty good here as well. So to the extent they kind of get thrown out here with the bathwater on any silver move lower, I would be more inclined to be a buyer of the base metals here.
And those potentially more reflective of this kind of cyclical global growth environment that we've been talking
Yeah,
about.
listen,
So,
I think, Russ, they're reflective of a few things. I think they're reflective of some cyclical global improvement with respect to the economy. I think they certainly still reflect resource nationalism. There's a lot of hoarding of, base metals and industrial metals going on around the world. And they are part of the AI power build out as well. So I don't know which of those three avenues is the correct answer. I'm sure it probably pulls from all three, but you never had the real blow off conditions in the base metals that you had in the precious. I think they're more attractive here for 26.
Chris, thank you as always for the time. We appreciate it, and we'll look forward to talking to you again soon.
Thanks, Ross. Take care.